Is it on?
You're on, yeah.
Hey, we're gonna get going in here. We had to improvise. We're using the wall as our screen, so if we got to move a little bit, move. I brought just a few handouts here. I didn't bring a lot. I just brought a few charts to hand out. The reason why is we have this all online, and you can go and print it off. You'll even be able to rewatch this if you want, so that will be posted here this afternoon. And we do have live, and if we get some questions online, I'm probably going to go to those and then come back here. If you've got questions as I go through, hit me up right away. I got to admit that this is probably the most challenging meeting I probably have ever done, and the reason why is just the circumstances and. So used to over the years, you're doing a meeting and you're talking about, the corn market and the supply-demand fundamentals and what's acreage going to do, and do I think acres are going to be up 1 million or down 1 million, or what kind of yield do we have, or, is the livestock herd growing a little bit or getting smaller, where the demand is, in today's environment right now. I mean, those factors have very little influence on the markets, and you look at it here today, it basically has zero influence. I wish I was a little bit better prepared to bring you some more facts in here on Russia and Ukraine and their impacts on the world market. I saw some things out here this morning that I'm going to share with you here, and it's just an evolving situation. I guess the one thing that probably sticks out to me is I had a call this morning from a client, and he first off he said, "Well, I'm kind of a history buff," and I'm like, okay, and I'm thinking, well, I'm not, so I want to hear what you have to say, and he made the comment to me. He said, Putin's invasion of Ukraine, the last time something like this really happened was Hitler. Okay, and he's like, when he started invading a non-threatening country and just all overpower, and that, boy, things can really change. And I'm thinking, well, yeah, you look at it, they called everyone who fought in World War II the great American heroes. And I know my wife's grandfather, he fought World War II. He's still alive today, and he's 99 years old. Okay, and so we're that generation that really lived that and fought that is basically passing us by. That was that long ago, and that made me think. I'm like, well, man, I'm only 48. Okay, I probably should learn a little bit about my history if we're starting to go back that far and what's happened and the impacts that's going on. The other thing that kind of has my attention on this whole situation with Russia is that in the UN and the Security Council, there's only 5 permanent members on the Security Council. Okay, it's a U.S., United Kingdom, France, China, and Russia. And right now, Russia is actually chairing that Security Council, and so it's kind of just an odd situation in here right now. What's going on in the world. My impression, though, sitting here right now this morning is I think the focus, and this should be from a market standpoint, okay, or an economic standpoint, is what is China's move going to be right now? Okay, I think that's going to be the big focus. Now, does China sit here and take a step back and say, let Russia do what they want to do? It's their situation, and maybe they're tipping their hand, and hey, they want to invade Taiwan later on, and then does that kind of piss everyone else off, the EU and the US, and saying, look at, if China's taking Russia's side, we don't want to do any trade business with China at all, okay? Or does it come in here where China condemns what Russia's doing, okay? And they kind of join in with the rest of the world. So I think that's just a real interesting dynamic. I don't know what Putin's going to do. I don't know what China's going to do either, okay? But I think that's something we really have to watch for, okay, as we move ahead. These are just some quick facts in here about Russia and why it's, from a commodity or an economic standpoint. Russia produces about 40% of the world's platinum, okay? And I just have these as handwritten notes down. I figured this stuff out this morning. Russia provides about 20% of the world's diesel fuel, and they supply about 10% of the world's crude oil, okay? Those are some significant commodities out there. When you look at on wheat production, this last year, Russia produced around 2.8 billion bushels of wheat. We produced around 1.65. Russia exports about 1.3 billion bushels of their wheat crop. We export around 800 million. Okay. With Ukraine exports about 17% of the world's export trade. The U.S. is the leader, followed by Brazil, Argentina, and then Ukraine. And you look at Ukraine's wheat production, they're around 1.2 billion bushels, less than the U.S., but they export a little bit more, around 900 million. So that's why when you see this market response in here today, where kind of the wheat was the leader, and then beans was the weaker link of the whole thing, and corn kind of went with it a little bit. So, that's just kind of a brief update in here on what's going on, or my take on it. Again, I wish I could have brought you some more information. I just don't have that in here right now. I think as I kind of want to move ahead in here on this meeting, and I hit on this before, but I wasn't on videos. When I used to prepare for meetings, it came down to, hey, these are the supply-demand fundamentals. This is the acreage. This is how we see demand shifting out here. And this is how you can see price changes down the road. And you're looking at it, whether if corn was at $4 or $4.50 or $5.50, that, hey, this corn market can move, 50 cents or $1 by the end of the year. Okay? In today's environment, corn can move $1 by next week. Okay, and it has nothing to do with acreage. It has nothing to do with who might be buying a cargo of corn or not. We're just moving because a lot of the outside influences in the market. And when you start looking at these outside influences, how do I get this thing to click ahead?
Good question. I got to go ahead.
As I we got technical difficulties here. Oh, there we go. So, these are some things on what I had down before this whole Russia, thing blew up yesterday. Is, I think you've got inflation out there that's a major issue. I think you've got some world conflicts out there that kind of moves really to the top of the heap. We've got South American production. Then we can get back here to U.S. Fundamentals, and I want to go through some crop insurance, at the end. I think the 800-pound gorilla in the room, though, I think is inflation. Okay, I really do. But just on the way down here today, and I hope my kids, when this is on YouTube, that they don't watch this video, because they're going to really think I'm a tight ass after I say this. But it was reported that Tooth Fairy, gives children right now an average of like $4.75 per tooth. Okay, that's up 14% from last year. And so the whole thing is, at least the Tooth Fairy was double what inflation is at 7%. But I hope my kids don't watch it, because my two boys, well, Jack is 23 now and Sam's 20. I think I only gave them a quarter when they lost their tooth. And my daughter, once I got to the third child, I just think, well, this isn't that big of a deal anymore. She got nothing. So I hope they don't come back and collect at the current inflation price in here right now. But this is inflation here over the last year. You can see, back at last January, February was around 1.4, just call it 1.5%. Considering you got a target of 1 to 2% or 2.5%, not a big deal. Well, then we got into the summer months in here, June, July, August, September, and inflation jumped up to around 5%. And at that time, everyone, heard the comment from the Fed, inflation is transitory. This isn't going to be a big issue. And so when you get back into the summer months, what the Fed was really betting on in here right now is that this inflation would come back down to, that 2 to 3%, okay, not jump up like it is right now and continue to accelerate higher, and sitting here just above 7% right now. And so here over the last month or two, the Fed has got to come out and saying, well, they're not going to say they're wrong, okay, but they got to look at, well, maybe inflation isn't transitory anymore in here with this run up. And so, to me, inflation right now is a big issue, and I think that's something that they're going to have to address. This chart might be a little bit harder to see in here, but this is inflation rates going back to 1960. And what I'd like to point out is when you get to those spikes up in there in the mid to late 70s, that's the only other time we had inflation above 6%. Okay, and we all know what happened in the 80s. Interest rates went up to combat inflation. If you updated this chart here right now compared to where it was, because this is just on an annual basis, 2022 would just start jumping up in here right now and it would be that next spike up. Okay, I mean, you look back right now, we're at 7.5%. I mean, last year it was just right around 1%. Okay, or when I'm saying last year, I'm saying 2020. I'm saying 21, 22 is together in here. I think that the other thing we got to keep in mind is interest rates. I think the best interest rate indicator to look at when we're going towards consumers, and I know from an economic standpoint, people want to follow the 10-year note, but I really think you got to look at a 30-year mortgage rate. And the reason why is that's what affects most Americans. Okay? And as you can see, through early 2021 in here right now, we had the 30-year rate, a low of 2.75, just up to around 3%. Well, now all of a sudden that's really accelerated and it's just shy of 4%. Why this 30-year mortgage rate, I believe, is the one that you need to follow is because most people have home loans. Okay, and everyone knows now the housing market has gone up. Okay, and everyone talking about, hey, housing prices, depending on the market, up 10, 15, 20%. If you're getting a $300,000 mortgage, and I think they say an average house in the U.S. now is like $260,000 or $280,000, on a $300,000 mortgage, on a 30-year rate, if the interest rate jumps from 3% to 4%, every 1% it jumps up, that's an extra $200 a month in a monthly payment. Okay, so if we're at $1,400 at 3%, we're at $1,600 at 4%. We're at $1,800 and if it goes to 5%. Okay, that is a big deal. That affects a lot of consumers out here right now. And everyone can be looking at past data in here and saying housing prices are accelerating. Okay, I would have to say sitting here today, okay, 3-6 months from now, everyone's going to be saying, look at housing prices have flattened out or even trended lower. Because the higher interest rates, we cannot afford as much of a house out there right now. I believe we got to watch this 30-year mortgage rate in here. This information comes from the government, Freddie Mac. Here we go back to 1970. You can see the increase in interest rates. The 30-year mortgage peaked out at 17%. I mean, I get back into the mid-90s in here. I mean, that's when me and my wife bought our first house. We borrowed our money at 8.25 on our very first house. We thought we had a great deal. Okay, we were living high in there at 8.25. Now you can get a 30-year mortgage. Well, it used to about 3%. Now closer to 4%. It's still relatively low, but even get back to 2007, 2008, before the housing crisis, and you had the housing market really running up, we had a 30-year rate around 6% then. Okay, so interest rates are going to creep up. I don't think they're going to go up like they did in the 1980s. The reason why I don't believe that is I look at the national debt. In 1980, our national debt was $1 trillion. Today, it's over $30 trillion. Okay. A 1% increase, okay, in there is a 1% debt is $300 billion, okay, in interest payments. If they want to jump it to 5%, they got a $1.5 trillion interest payment every year. Okay, I think our large debt in here right now is going to hold down interest rates. But on the other hand, when I'm saying they're going to hold them down, that doesn't mean that they're not going to go up from here. They're just probably not going to be explosive like they were back in the mid-1980s. This whole national debt deal. Here's crude oil. I've got crude oil chart here going back to 2015. The red horizontal lines on there are between $40 and $70 on crude oil. Okay. You look at it from the Trump administration from 2016 or 17 through 20 in here, really kept crude oil in that $40 to $70 range. Encourage production in the U.S., encourage drilling, okay, encourage U.S. becoming self-sufficient. That was really a policy that someone who leaned a little more conservative, put in place. Now when I take a step back and I look at a monthly crude oil chart going back to 2000, my two red lines up there are between $80 and $110. Crude oil just traded to $100 today. You go back, to the previous administration, we spent significant amount of time between $80 and $110 on crude oil. Okay, you know, they had on here that inflation's a big issue, energy prices are a big issue, and a lot of it is going to be political driven. I mean, I'm sitting here, I don't want to get into a political debate with people. I mean, that never ends good. But you have to acknowledge the parties that are in control and the policies they tend to put in place. Okay, you know, crude oil prices are trending higher in here right now. You know, the one thing I always tell people when I fill up the gas station up the road here, and right across the street from the gas station, there's a Walmart Supercenter. Okay, and when I go into the gas station, I look around, and you know, it doesn't matter if you're driving a GMC Denali pickup truck or you're driving a 30-year-old Dodge Caravan. Okay, the gas pump doesn't care. Everyone pays the same. And what you see at this gas station go on, people get gas in their car and then they drive over to Walmart. Okay? Now, it doesn't take much of an economist to figure out, but when gas is at $3.25 a gallon compared to when gas is at $2.25 a gallon, people have less money to spend when they go over to Walmart. Okay? You know, this energy is a big deal. You know, a comment I saw this morning is, hey, are we going to have $6 diesel fuel with this whole situation in Russia and Ukraine? I mentioned in here already a little bit of politics. I don't really want to hit on this anymore. You know, Russia, Ukraine, I really think you got to watch China. I think in the U.S. in here with energy prices jumping up, you know, I think the thing you got to see is what's going to happen with an election coming this fall. Does this current administration change your mind on the Keystone Pipeline? Okay, do they change your mind on federal natural gas and crude oil leasing rights? And then the other thing that's going to be a big issue in here as we move ahead, and this is no matter, you know, who has the White House or who has Congress, is what is biofuel policy going to be like, you know, as we move ahead. You know, so there, you know, I wanted to cover some of the outside markets in here, some things we may not particularly think about, but I really believe that when you start looking at inflation, when you look at energy prices, when you look at politics in here, it's having much more of an impact on these markets than what we'd want to think here just even a few years ago. If you have any questions as I go through, raise your hand. I know one thing I do is I probably talk fast, but hey, that's the way it is. As we get to the agricultural markets, I mean, the big question here is South American production. What do I think is going to be like here in the U.S. And then we'll take a look at both the grain and livestock markets. I want to highlight here, and I have their production in millions of bushels, okay, on what the USDA has done with South American production here over the last 4 months. Okay, in January, if we just go down to the bottom number in here, you know, they were projecting we're going to raise around 7.55 billion bushels of beans in South America. In South America, you usually put Brazil, Argentina, you know, Paraguay, I'll lump them all together. If you get towards the last column in here in February, you can see that their total production is down around 6.8 billion bushels. They're dropping their production down 10%, okay? There's only 2 times in history the U.S. yield dropped more than 10%. Okay, 2003 when we had aphids late in the year, and 1988 drought. The 2012 drought, our national yield was down 9% from the beginning of the year. Okay, so what we're saying is going on in South America is that it is really, 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 really bad. Okay, it's something we've only seen from a drought perspective really one time in our history. I don't want to sit here and debate South American bean production on what I think it is. What I find just ironic, though, is that the state of Mato Grosso in Brazil raises, they say 28% of Brazil's beans, so figure 30%. Okay? They're going to have an average yielding crop, increased acres, they're going to have record production. Okay? I mean, that's a fact. They're saying this crop is so bad. And if I relate it to the U.S., it would be like Iowa and Illinois having a normal crop. But the rest of the country is so bad, it's worse than the 1988 drought. Okay? Now, I'm not going to tell you that's impossible to occur, but if we were looking at information here in the U.S., we'd kind of be scratching our heads a little bit saying, man, can it really be that bad. Okay. I think an interesting stat out of South America is that their producers, compared to average, are around 15% behind on selling beans. Okay, just like the U.S. producer, hey, I don't want to sell as many because the year before the prices went up, and so they still have a fair amount of soybeans to sell down there. Right now, you look at Brazil and U.S. beans are around the same price on old crop, but they have a shipping advantage going to China around 20 to 30 cents a bushel. That's why when China's buying beans right now, they're buying our new crop because we're cheaper, okay, on a new crop compared to what South America is offering. Right here on beans, you can see the big rally that we had, starting in January on the smaller South American bean crop. I put this line in here at $16 on soybeans. Why I have it at $16 on beans is if you go back to 2008, 2012, 2013, even last year, the time we spend above $16 is very, very rare. I had a guy tell me, this is a couple weeks ago, that he was at the elevator and a buddy was there and saying, "Oh man, do you think beans are going to go to $20?" And he looked at him and he goes, "Well, why does it really matter to you? You'll have them all sold by the time they hit 18 anyway." So, I kind of laughed about that. And, I don't know what's going to happen in here on this bean side of it in the near term. I mean, it's some strange stuff going on at the outside markets. What you are seeing in South America, though, is that you're getting some crop estimates right now where this crop is not getting smaller anymore. They're starting to increase it. So the low estimate for South American beans is probably in place. Here, I'd just like to bring up our ending stock levels. You can see where they're at right now. They're kind of midpoint, a little bit above over the last 7-8 years, okay? But yet price is exceptionally high. And you look to the world ending carryout on beans right now, I mean, they're not exceptionally tight, okay, to justify these higher prices. So like I mentioned in the very beginning, fundamentals on the bean market probably point towards bean prices more at around, $11, $12, or $10 to $13, not at $14, $15, or $16. Here's the corn market, and I don't have the overnight trade in here right now as it made new highs. You can see we got above 640. That's where the high was this past spring. And again, I bring up a monthly corn chart and I put 750 on there. Similar to beans, 2008, 10, 12 in here, and even last year, went up 750 in here. Okay, and really, no matter what were the fundamentals then at that time, we're not able to push above that. So, I think this is just a good thing to keep in mind. Here on corn is our ending carryout. You can see it's not like it was back in 10, 11, or 12. Okay, I don't know if this type of ending carryout really justifies this kind of price. But on the other hand, this is where we're at right now. But I think what we have to look at on this corn side of it is that, with usage kind of contracting a little bit, unless exports really surge in here, we could be building our corn stocks up some. Here's world ending carryout levels. Why they jumped a ton in 12, 13, 14 time frame is that China adjusted their carryout levels. I don't really know if you can really believe anything that comes out of China, but hey, they adjusted them. That's why you had that big run up at that point. And here, ending carryout levels are going to grow a little bit from a year ago. I just wanted to bring up a wheat chart. Front month wheat went above $9 today. That's targeting that 2012 high. Again, I went through those numbers, on the whole Russia wheat production early on, and Ukraine's wheat production. If you want to be bullish off of Putin invading Ukraine, it's probably going to be more so on the wheat market than anything else. I want to hit on the livestock markets a little bit here. Just like the grains, you can see livestock prices are stronger. I think livestock as a whole is going to be a good market looking ahead. And the reason why is there's just no expansion. Okay, and we might have these higher prices in here, but there's actually no incentive to expand. I mean, the cost of inputs from feed, the cost of placing animals, and the biggest thing is building costs in here right now. I mean, literally, you have some dairy operations, hog operations, that if they would like to expand, just economically can't do it. The building costs are just way too high, even at lower interest rates. So we're just not seeing any expansion at all in the livestock. Now it comes down to, does the consumer hold these kind of prices together? Okay, and it goes back to the inflation side. The one thing I don't like is it seems like food prices are getting blamed a little bit more than anything else, for inflation, or it's actually, energy prices and transportation. Okay, and that's the big culprit in here right now, more so than food. And I just kind of use this scenario. Here a week ago, I stopped at Aldi. I got, it was Walmart with my daughter, and I got pork tenderloin, a bag of potatoes, and I got like 4 bags of salad, and it was $16. Okay, the pork tenderloin that wasn't even on sale was $3.50 a pound, and I'm like, oh man, this is cheap. Okay, well that next night, not that night, the following night, she had a basketball game, and so we went to Chick-fil-A afterwards, and here it was $29 for 3 of us to eat at Chick-fil-A. Okay, well, that meal at home is still pretty cheap, and I'm just afraid, that agriculture is getting blamed more on the inflation side of it, where really it's all on the transportation cost. Okay, because I think pork at the store, beef at the store, chicken especially. I mean, it is relatively cheap. I think these values are going to hold. I think the livestock industry, has got some good holding power in there. If it does come under pressure, it's probably going to come under from the outside markets. Here's the live cattle side, but as you can see, we haven't had $1.40 cash cattle in a long time. I mean, it's been, 5, 6, 7 years. Just like the hog side of it, we're not getting, any expansion in here at all, on the cattle. I mean, you look at cow slaughter, I mean, that's up in here, and it's not going to change. Okay, the trend of a smaller herd out there is going to continue. Where I think the cattle market can run into a little bit of problem, though, is the choice select spread. Okay, I mean, usually it's running $10 to $15. Choice is a premium to select. Okay, right now, select is at a little bit of a premium to choice. So we're going to stores and consumers are rejecting the higher price choice cuts in favor of cheaper select cuts. Okay, so that's kind of a warning sign to me on cattle when you start looking at box beef and the 260, 270, 280 a pound, that consumers are maybe starting to reject that a little bit in here, saying, hey, beef is getting too high, I'm going over to pork, okay, or the chicken side of it. I mean, you look at it. I mean, I just said you bought pork tenderloin at $3.50 a pound. You can buy boneless, skinless chicken breast, for $1.99 a pound. But yet, a New York strip steak, if you find it on sale, is $10 a pound. Okay, so you can see more money at the gas pump. Hey, we got to go somewhere else. I think that could maybe limit the cattle side of it, but our supply is down. Here's on the milk. That line is at $20 in here. We've got good milk prices. Again, with dairy, there is no expansion. The costs are just too high. Okay, building costs are too high. Feed costs are too high. Now interest rates are jumping up. We're just not going to get any expansion in here. The consumer is going to support $20 milk. Again, the risk is going to come back towards, the outside markets that way. Here I want to, you kind of wrap things up in here on the market side of it is, I'm one, you can tell me the fundamental news out there and it's not going to matter on day-to-day movement of grains anymore. Okay, it just doesn't matter. I mean, the weather forecast in South America basically changed over the weekend. Good rains forecast for Argentina and Brazil markets go up in here this week on beans. Okay, I mean, Russia can move the wheat market more than what anyone else can produce. Okay, on a global conflict. And so, we just got to that point. I think if you're going to look at fundamentals on the world market, I think what you need to watch is where the U.S. is priced relative to the rest of the world. Okay? On beans, we're not competitive with South America on old. We're competitive on new. Export sales are announced. They're out on new crop. Corn sales have been slower recently. Corn sales have been slower because Ukraine is offering corn on the world market cheaper than what the U.S. is. Okay, I say that because that's what it was here last week with the current conflict. I don't know where things are changing at in here today. On the wheat side of it, again, you had Ukraine, you had Russia, you had Romania, you had French wheat, all priced out lower than the U.S. That held the wheat market back. Okay, Again, though, you got the Russia thing. So I think when you start looking at fundamentals in here, you got to really watch the world prices. That's something that we track in here every day we look at it, but we really track it every week on how that spread difference is trading. You got to manage risk, production risk. We're going to hit up on this on crop insurance, price risk. And I have at the end is extend good times. The one thing we got to feel fortunate about in production agriculture right now is we're really at the forefront of this inflation move. Okay, our prices are heading up, and I know our input costs are going up as well too. Okay, but seed, chemicals, fertilizer will not be going up if corn was at $4.50 a bushel. Okay, they're going up because you got corn at $5.50 or $6 or $6.50 a bushel. It's just all a reflection of, hey, they know what you're getting that way. So it just comes down to, hey, there's still some good times in agriculture in here right now. How long do they last? That's the $1 million question. Before I get into the crop insurance side of it, any market questions? Okay. And I don't know why I'm asking questions, or saying ask some questions, because most likely I'm not going to know the answer to it anyway, because this is kind of a crazy environment. But I want to be polite and see if you have some questions that way, because that's a good thing to do. So what would we do? Okay, and what are we going to encourage guys to do, and how are we going to move ahead in here? With this kind of environment that we have in place. I just have down, on crop insurance, livestock insurance. What's changed a lot since we've been doing insurance the last 10 years is, okay, there's more and more programs out there for both crop insurance and livestock insurance. And almost all those programs are more market related, okay, and relate to the price you're receiving. And all the new programs that way, then coming out like with a new production program, okay, or how to protect you that way. And the trend recently is that 10 years ago is almost every new add-on program that the RMA came out with is I could look at the markets and say, well, this doesn't make economic sense because you can do this in the markets instead. Okay, we're moving to the point right now though where the subsidy rates on a lot of these programs on both the crop, okay, and on the livestock side of it. It really makes economic sense for you to do things on the insurance side of it compared to looking at an option contract. Okay, that's just the way things are. So whenever we got a livestock producer, let's use a dairy producer as an example. I want to buy a milk put. No, you probably should look at your dairy insurance instead. Okay, and that's something. Okay, that we have to look at from both. We work together with Craig on this, just from both an insurance standpoint and market standpoint. What's the most economical way for you to get coverage in place? So that's something that has really, really changed in here. I'll give you some examples on that. You got to make some informed decisions. Like I said, recognize opportunities. The last thing we have down there is keep it simple. I think when you have decent margins, the best thing to do is just keep some things, pretty simple. What to do with a farm program and crop insurance. One thing we get in here, PLC versus ARC. Most situations, and Craig could probably answer this a little bit better than I could, but I would have to say it's well over 90-95% of the situations, PLC is an advantage over ARC in today's environment. Okay, you're going to probably maybe find some crops or some areas of the country where that's not the case, but that's in general. The one thing in here right now is if you use PLC, you can utilize SCO for your federal crop insurance. If you elect ARC, you cannot do that. Okay, so that's something to keep in mind. SCO is similar to the old GRIP program. Okay, where it's basically a county-based yield off and the price, and you can get that up to 86% coverage. And then basically, and it's newer the last couple of years, they've got the ECO program, which is also similar to GRIP, and that can cover you from that 86%, up to 90 to 95%, okay, in what they're offering on their insurance. I think a thing to keep in mind, and I put this chart down on the bottom, is you need to recognize the different subsidy rates for the different federal programs that are out there, okay? When you look at on regular RP, revenue protection insurance, if it's 70% or 65 or 60 down to 50, you got an 80% the government's going to pay. At 75%, they're going to pay 77%, 80% 68, 85% down to 53%. Okay. When you get over to the subsidy rates on both SCO and ECO, on SCO the federal government's paying 65%, and ECO they're paying 44%. So you need to know those subsidy rates, because that's why when you look at this and saying, hey, this is why 75 or 70% insurance is a lot cheaper than 85. And this is why ECO is much more expensive than SCO. It just comes down to how much of the share is the government paying. Now, I brought up, on the slide before where, you compare it to what you can do on the marketing side of it. When these programs first came out and you had, subsidy rates down at 20 or 30 or 40%, it was much more economical to go and use a futures or options contract than coming over here and using an insurance program. Okay. As it got to 40%, it was like, hey, it's still probably more economical, to go the option route than using an insurance program. The 50% subsidy and above, okay, you're way better off going the insurance route. Okay. That's why I see on the livestock side of it, a lot of insurance agents struggle on relating to producers and what needs to be done, because an insurance agent, they're trained just to sell you the most premium. Okay. They just want to sell you the highest policy every single time. Well, you look at it, the highest policies don't have the best subsidy rates, okay, and don't make as much economic sense when you look at something else. So, you look at the dairy side of it, if you can get a larger subsidy rate, having an $18 floor in place compared to $18.50, hey, maybe you're better off going down to $18. It's much more economical for you to do. So that's something we got to always compare what's going on. This is another thing that we always go through, and I don't have Wisconsin on here. I mean, we broadcast this out, and I thought it was easiest for us to use an examples of Iowa, Missouri, and Illinois, and putting a crop insurance quote together and different costs, and how we come up with a recommendation, and then we kind of base it, hey, how do you want to vary it from here? So when we look at Iowa, if we're buying revenue protection, and then we want to put an SCO on top of it, if we're at 60% coverage, our cost is $23.91 per acre under 200 bushel corn. If we're at 70%, we're at $22.22. 75% is $21.79. 85% is up at $33.54. Okay, you can look at the numbers from Missouri. You can look at the numbers for Illinois. Okay, the same 200 bushel APH, same national average on corn. Okay, that's just a different cost structure to base on where you'd want to go to on this. So if I look at this producer in Iowa, I'd come to him and say, look at, the most economical one to do is at 75%. Revenue protection, put some SCO on top, that's giving you your best bang for your buck. But if we look at their yields then, if they're a producer, okay, where their actual yield is above the county, because when you go to the SCO and ECO, that's all county based on the average, they might be better off bumping up their coverage in here on their revenue protection because they've got a stronger yield. If their yield is below the county, they might say, hey, I want to rotate down a little bit on this. So we kind of come in with a guy from Iowa and say, hey, it looks like 75% is good. What's your yield at? Yeah, hey, you might want to bump it up if you want to do that. Do what you're comfortable with on that kind of a program. But you can see for us, or at least what we like doing, is what makes the most economic sense. Where are you getting the most bang for your buck on this position? Okay, or not in this position, with this crop insurance policy. So on here, I highlighted, I'm just going to go on this yellow one. What I always get is, and I have to tell people this, is, well, how much do you make on selling this policy? Okay, what are you bringing in? And I like, showing people this or letting them know about what it is, just from a standpoint that, hey, I want to get you the best policy for you, okay, and your operation is much more important than what I'm going to be able to get, okay, out of it. Because I need you to survive long term. I need you to be profitable on this. And so, I always like putting this thing up front. Hey, this is what it's going to be. So you look at this guy in Iowa, if he buys revenue protection in here at 75%, his producer premium's $8.15 an acre. And the agency is going to bring in about $3 an acre off of that. If he buys the SCO to bump him up, that producer premium's $13.64 an acre. the agent's going to get $6.24 an acre. If you sell them to ECO at $32.72, they're going to get paid $9.35. Okay, what it comes down to on this thing is when you look at it on the actual premium. So you have a producer premium and the actual premium. The actual premium is when the subsidy's not in there. You get paid about 8.5% on the revenue protection policies, okay, on your commission. You get paid about 16% on the SCO and ECOs, okay? If you bump down to 80% coverage in here right now, you can see how this changes in here. This is why when we're sitting down with a guy from Iowa, okay, in here and saying, look, this is what you need to do. The pure numbers tell us, if I'm just looking at this number, it says we should be at 75%, okay? If the guy has his yields, his APH is below the county, okay, we're going to probably say stick with the 75%. But if it's above the county, we're saying, you know what, you might want to go up to 80% coverage on this. And the reason why we share these commissions is we want him to walk away from this saying, look, they're explaining this to me, okay, and they want me to do what's in my best interest. They're not sitting here worried about whether if they're going to make another $1 an acre or not by selling me this policy. Okay? ECO is popular. Agents love ECO. Just no doubt about it. Okay? I had a guy in North Dakota ask me, he goes, hey, can you tell me these commission rates on insurance again? You know where they're at? And I'm like, sure, I'll tell you what they are. I've got nothing to hide. Well, why do you want to know? He's like, well, he goes, the weirdest thing that's going on up here, he said, is some of the bigger crop insurance agents are the people all out buying farmland now. Man, they must be making a killing on what they're selling us. And I'm like, I don't know what they're doing, but this is what's going on, okay? And the federal government sets these rates. We don't set them, okay? This is what we basically told, hey, what it is. And again, and we probably should have cut this out on a live webinar because this is probably going to get shared thousands of times and every crop insurance agent in the country is going to send me hate mail, okay? I really don't care. I want you to make a more informed decision, okay? That's our whole point with it. I'm not sitting here calling anyone out. I'm not saying, well, such and such, crop insurance agent, they just bought a farm or they bought a new house up north or they bought a $100,000 fishing boat. I could care less what other insurance agents are doing, okay? It really doesn't matter to me. Again, it comes back towards, our motivation in here is to help you make a more informed decision in what's going to work best, for your farming operation. That's our goal on this. Again, it's not that they have anyone be mad at us or what's going on. This is just a fact that's happening here. So now if you go and you meet with someone on the insurance agent, and here's our Iowa farmer here, they all want to know, well, where am I going to get my payments? And again, and I'm not a history buff, I admitted that early on, and we've only been doing insurance for about 12 years. But our personal experience is that years when farmers don't get insurance payments, they make more money farming than years they do get insurance payments. Again, that's just kind of our perspective on it. Okay, I'm not saying you can't make money on insurance. Okay, in fact, I did just make some money on insurance, and I'm going to tell you how I made money on insurance. My son was in Chicago, and he had to move, and I'm like, sure, I'll move you back home. And here, he works for GE Medical, a 6-month rotation. He went from Chicago down to South Carolina. Me and my other son, I said, hey, I'll take a truck and his pilot down there. We'll be able to throw all this stuff in there. Go. On the way there, my son behind me, driving the pilot, got hit in a roundabout. Okay? And I'm thinking, oh man, this thing sucks, okay? Never got hit. Insurance claim, this is fine. He takes the car to college anyway. It gets dented up and beat up there. They were going to total the vehicle out. And I'm like, the thing still drives. I'm like, I know I need to put new airbags in it. Okay? They're like, well, new used vehicles up a lot. You can keep the vehicle and we'll give you $8,500. And I'm like, sounds good. I'm like, I'm going to keep the vehicle. I'll drive straight.
I got a bid to get the airbags fixed and new seatbelt, but not fix the dent, and I got that done with for $4,000. And I told my son, I said, you're going to drive a vehicle to college and a dent on it, and I don't care. I said, we got an extra $4,000 in our pocket. So when I come here and I say you can't make money on insurance, I need to tell you I feel pretty good because I just made $4,000 on insurance, and my kid can still drive his vehicle at college. So, but with crop insurance, most likely, okay, you do not make more money when you collect insurance compared to people who don't. Okay, so you're going to see this handy chart here saying, hey, if your yield is down to 160 bushel an acre, you're going to get $199. I guess I'd rather have a big yield, okay, and have the bushels to sell. Here's on these SCO payments and how they're going to work with the old county, drip on what the county yield is. You can see here if corn goes down to $4.75 a bushel at 200 bushel corn, you can get $57 an acre. And saying, hey, government's paying more of a subsidy. This might work okay into my program on what I would want to do. Now the big thing here is this is on the ECO payments. Okay, and you notice that they cap out at $105.48 on this thing. Okay? And why they cap out on that is that's a difference, okay, between the 95% and 86%. Okay? So on this 200 bushel acre farmer, it's going to peak out at $105 an acre. Now, when you start looking at the math, okay, on this revenue protection program, on this ECO payment, I got to find my sheet now that I wrote this on. If I can, I still think I remember the numbers. What it boils down to is if we're starting at a $5.90 price, okay, 95% of $5.90 is $5.60. 86% of $5.90 is $5.07. That difference is 53 cents a bushel. Okay, 53 cents a bushel on 200 bushel corn, you come out to $106 an acre. I'm off by 52 cents. So what ECO is basically is it's a put spread. Okay, you're buying a $5.60 put. You're selling a $5 put. That's all that it is. Okay? People are calling this extra coverage or whatever. You're basically putting a put spread in place. Okay? Granted, you got a county yield variable in there. That's fine. So if your ECO is going to cost you $32 an acre, okay, and you got 200 bushel corn, that's 16 cents a bushel. If you can put the put spread on cheaper than 16 cents, you're way better off putting a put spread on your corn if you want this price coverage, okay, than this ECO. That's basically what it is. So whether if you're looking at corn or soybeans, where you're at in the country or spring wheat, okay, this is basically an option position. And what is going on in here right now, and I mean, I'm not going to say good or bad or whatever about the crop insurance industry. This is just the facts, as they have a really strong lobbying group. Okay, and that's a huge benefit to you. And again, I explained earlier on, the trend on what is happening on crop insurance is it is basically replacing you using futures or options. Okay, I'm the first one to admit if you say, look, I want this ECO because I think I can get this payment. And I look at it, I can put this option position on and I can make you more than the ECO if this happens. You probably should put the option position on. Okay, if I can't, if the ECO pays better and you want to put this in place, put the ECO in place. Okay, that's why we like showing you, hey, this is what we get paid on the ECO. If you want to do it, do it. But like Craig made this comment to me, he said, look, he goes, we go out and we show people, this is what we're bringing in, this is what it's doing. And this is the reason why we do it, is that our feeling is that if we come out and just push to you, and I'm saying push, to buy this $32 policy, okay, your expectation is I'm buying an extra $32 policy, I'm going to get a payment off of this. I'm solely putting this on to get a payment, okay? And if we just push it and there is no payment at the end, producers are going to be disappointed, okay? After you present them the facts on what it is, then you can make a more informed decision. Yes, I want to do this. No, I don't want to do this. Okay? what you're having out there, and this is literally how these numbers work. Okay, again, I can't make this up. Crop insurance agents will make more per acre getting you to put that ECO policy in place than you buying your regular revenue protection policy. That's the facts. Okay? Now, if I work for an insurance company, okay, and you guys can pick any bank or insurance company out there, okay, that's owned by someone else, and I was out here sharing this information with you, okay, and what I have just told you in here right now, I would guarantee you, especially since this is live on the internet right now, that I probably wouldn't have a job by the time I got out the door. Okay? The insurance companies are developed, and I don't care if this is life insurance, auto insurance, crop insurance. They are developed to sell you premium. That's what they're going to do. Okay? And again, we're in the insurance business. We're going to sell you insurance. I'm not telling you not to buy insurance. Again, what I need to stress to you is you've got to make a more informed decision. This is the best way for us to show you how to make a more informed decision. Hey, I don't have to worry about this. I'm not going to fire myself on the way out. And I doubt if my wife is watching this right now, but she'd probably be embarrassed on a few things I said. So, I mean, I'm safe. I'll be out the door and back to work, and I'll still have a job. So, I'm good. So what to do? I mean, you got to buy revenue protection. Okay, I think that's a definite buy. SCO, my opinion on that for how economical it is. Okay, I think that's something you look at doing. Okay, so it's me. I'm telling you, when I'm going through the numbers in here right now, I'm buying revenue protection. I'm buying SCO. I'm doing what the numbers tell me that way. ECO, I mean, you know, it's a toss-up to me. I mean, you know, for the farmer. So I mean, this is the dilemma. If I'm putting my farmer hat on right here, I'm looking at this saying, man, I don't know if I need this or not. If I'm putting my insurance agent hat on, I'm saying, man, let's sell the shit out of it. Okay? That's just, I showed you, if I said anything different, I'd lose all your respect because I'd be lying to you. I mean, those are just the facts and what it is. ECO is capped out compared to options, okay, whether you want to put a put spread or not. I mean, you can tend to get more gain with options than an ECO. ECO is a county yield variable, options do not, okay? So, you know, if your county yield went up 10% and the market went down some, you still might not get paid on the ECO because of that county yield. So that's something you need to keep in mind. You know, I'm one where when I look at prices in here, right now, and I got to tell you, just a simple plan is you buy revenue protection, hey, I'll throw a little bit of SCO on top of it, and you go and you sell half or 60% of your crop ahead, and you say, you know what, there's a lot of weird stuff going on out there, but the one thing I know for sure is I'm going to make money in 2022. Okay? I mean, I got to tell you, you know, sitting here, you know, right now, this next fall, you know, and I'm just going to get away from the corn market. On fertilizer, I don't know if anhydrous is going to be at $700 a ton or if anhydrous is going to be at $200 a ton. Okay? I mean, anhydrous can be at $700 a ton if corn's at $450 and crude oil is at $60 or $70. Anhydrous could be at $2,000 a ton if corn's at $7 and crude oil is at $120 or $130. Okay? I mean, there's just so many different factors on what's going on. Here's a December corn chart on where D's corn has been historically. You can see except for 11 and 12 and then going back to 2008, we spent very little time, about $6 on corn. Okay? You know, very little time that way. I mean, how much we go down, you know, I don't know. On beans, that's just $14.50. Okay? You can see we spent very little time, about $14.50. Today's spike high November beans was like $15.55. I remember back, and you hear different comments that stick with you. This was in about 18 months ago. I had a guy say to me, you know, in the spring of 2020, he goes, this is less than 2 years ago, I was out planting soybeans. My new crop bid on soybeans was $7.70 a bushel. and I was wondering, how am I going to pay my bills? Okay? That was just 2 years ago. I'm a firm believer, okay, and granted you have policy, government policy going, playing into this some, but I'm a firm believer that the world cannot raise enough $7 beans and $3 corn. Okay, there's no economic incentive for you to raise it, and there's way too much incentive to be wasteful on using it at those prices. Okay. On the other hand, I'm a firm believer that the world is going to raise way too much $6 corn and way too much $14 beans and way too much $9 or $10 wheat. Okay, and that it will end up going back down. There's just the economic incentive there, okay, to overproduce in here right now. So I mean, I think the thing is you got to just take a step back on these charts. That's where I mentioned before, and I'm going to stick with this. I think the livestock industry has a little bit longer legs to it, okay, and holding together higher prices because it takes that much more to get that production back ramped up. I mean, if you're going to put in a new sow unit and get market hogs out, if you decide, hey, I'm going to build a new sow unit today, okay, by the time you got, the government and your permits and you get this thing built and you get sows in there and pigs are born, the pigs go to market. I mean, if everything goes just completely smoothly, you're probably a year and a half, if not 2 years out, okay, before that first market hog's going to come into play. Okay, I don't know how long it would be on the dairy side of it. I'm sure chickens would be a little bit faster than that. But, it just takes a long time to get that production going back the other way. So I think the livestock markets have a few more legs underneath of it. Here are some final things. I'm going to wrap things up. Top thing is, and I hate to say this, but fundamentals don't matter as much today. I mean, they just don't. Okay. I think that if crude oil is going to be at $120 a barrel, I think corn's going to be good. Okay. I think corn is an inflation hedge. Like I had a corn farmer tell me, he said, he goes, well, I don't mind putting $4 diesel in my pickup truck as long as I sell my corn for $6. And if diesel goes to $5, if corn goes to $7, that doesn't bother me either. He's like, man, he goes, it would kind of suck though if diesel was at 4 and corn went down to 4. Okay, and he's just kind of laughing about that. I'm like, well, you know what? That's a good point. But corn is going to follow energy with our current administration where things are at. Focus on protecting your margins. Again, I put on here extend good times. We got to be satisfied that agriculture right now is at the forefront of inflation. Okay, cheap interest rates, inflation in here right now. Ag markets are strong. That is a positive for us. How long does that continue? That's the biggest question. I already hit on the fall anhydrous. Where is it going to be at? Politics are huge. Okay, I mean, I have this down there. I probably should have that as bold up on top. Politics are affecting your bottom line more than anything else right now, and that I don't think that's going to change. Okay, that's going to continue that way. Don't try to outguess. I kind of like just having a simple plan. I mean, you got to remember when the market's going up, whatever you sold yesterday is always too low. Okay, when the market's going down, though, whatever you sold yesterday, I wish I would have sold more. Okay, I mean, these are good margins in here. It's going to be challenging, but we're excited about the markets and excited about agriculture and the opportunities that are presented out there. If you have any questions, willing to take some in here. I know we tend to get a lot more questions. People just call and ask, and then I know since we've started doing the weekly webinar, I'll get calls, hey, address this, and so that's what, I try to do, on different subjects or different topics out there. I appreciate people, everyone showing up here. This is great. I know weather is a little challenging. We pushed our meeting back this year, because our original plan was going to try to do it somewhere else, and just with all the COVID restrictions going on, whether if I believe them or not, you kind of got to do what you're told in some areas. So, I pushed it back. I think next year we'll probably try to go back to December with it. But thanks for showing up here. Thanks for people tuning in online. And again, any questions, we'll hang out here today. Give us a call or drop us an email. Thanks a lot. Oh, I got one last thing. This is for FFA kids. we're trying to, FFA's celebrating their 75th anniversary, and doing a scholarship on a video in agriculture. So, that's something we're trying to, promote not only here locally, but, also around the country, to do that. So we're going to have that going on here over the next month, and a way to try to support the FFA programs. But thanks a lot for coming here today and tuning in. And like I said, any questions, let us know. We good?
Mm-hmm. Nothing's, you're getting a question on here.
Oh.
Somebody's typing one in. There were.